Welcome to the daily update, where I'll go over the action in the market for Wednesday, February 5th, and we'll see how things look for Thursday, February 6th. Okay, well, we were leaning a little bit more towards the negative side after Tuesday. Well, now after Wednesday, we're leaning back more over towards the positive side. We're seeing some improvement in the broader market. That's helping the internals of the S&P 500 as well. And growth didn't have all that great of a day. The mega caps and the NASDAQ 100, they actually underperformed. We saw some strength from the mid caps and the small caps. So we're seeing some improvements along the way. Our smart money indicators are still looking positive, but as I've been saying, a little too positive right now. They're getting rather extreme, but we still maintain a positive stance because we're above the 20, 50, and 200-day moving averages. Okay, so we had a lower open, and Google came out with their earnings. They paired a lot of their losses before the market opened and then throughout the day, but that was really dragging the futures down. And we opened at the daily pivot at 6,024, and we got down to S1 just a little bit above that at 6,005. So now that 6,000 level is acting as support. It has for a couple of days now. So if we do start to decline, we'll be watching that level. And that set the intraday low. And we spent the rest of the day climbing back. We got to the daily pivot, we got to the unchanged level, then we went positive, and we climbed up to R1 at 6,057, and we closed at the intraday high. We were up 0.39% on above average volume, and we are still positive in the short, intermediate, and long term. We're going to be getting the employment situation report on Friday. We have more employment data that's been coming out, and it's still showing that the economy seems to be doing well. We get a little bit of mixed data on employment with the different reports that come out, and so a lot of the market will be focused on what's released on Friday. Of course, the geopolitical things going on. Yes, it looks like the U.S. wants to buy Gaza. It's a negotiating tactic with the idea of some other type of plan actually coming about that way, especially in the Middle East. So we'll have to see how all that works out. And of course, what was major news a day or two ago now seems to drop off as new things are replaced because things are changing very quickly. Okay. President Trump stated that the U.S. would take over Gaza in a press conference, and this was with Israeli Prime Minister Netanyahu. So it's not like he just said this on the fly. They were actually together in the same room. As far as the stock market, the broad market outperformed mega caps, and mid caps and small caps also outperformed. They had a pretty good day, and they're showing some improvement, but we're still seeing a mixed picture with the small caps. We have one of our indexes that's getting above its 50-day moving average, the other one that's a little below, and I'll show you that chart. And this is probably what helped the market, at least from my point of view, because I've been really watching this, and it seemed like once this finally happened, that has helped things to turn back more positive, especially with the small caps and mid caps. The 10-year yield is under 4.5%. And that's what started to cause some problems when interest rates were going up. Now, if we can stay below that and even continue to drop with interest rates, that might help the broader market and it might help the small caps and mid caps even more. Now, we still have the slope oscillator that's declining though, and it's below its moving average, but it's still looking extreme positive. And then we have the Chaikin oscillator. This is one of our smart money indicators that's starting to look extreme positive. We're just a day or two ago, it was turning negative. The mass index, that's another indicator that we look at. I'm probably going to stop showing that here pretty soon because we're getting beyond when that signal was actually triggered. But the idea behind this is that whenever it fulfills the criteria, it suggests a reversal is in order. But we're just kind of chopping around sideways right now. No change to the overall scenario as it involves the Fed. The dollar was down, interest rates were also down. Again, we're at 4.42% with the 10-year yield, where we had been at 4.51%. Sentiment actually ticked up a notch. We're still negative at 40, where we had been at 39. You got a lot of folks that aren't really trusting what's going on. They're seeing this choppy sideways action, and so they're not turning really positive on things. Now, we have turned positive with the ADX though. Now, we've been shopping around. A few days ago, we were positive, then we switched over negative. Now we're back to positive. So we're not trending. That's the issue, is that we're in a real choppy market right now because we're below 20 and we're below the moving average. With the up day, our bias is positive, and instead of being mixed when we had an up day yesterday, I decided to change it over to positive because we're seeing some improvement with our indicators. But I'm still keeping our momentum at mixed because we're not really trending right. There's really not a lot of conviction going on here. So we did get the trade balance that came in at a minus 98.4 billion, or they expected a minus 98 billion. Okay. And also a lower number here than the minus 78.9 billion that we saw last time. The global services PMI came in at 52.9. That's above 50. That's the takeaway from this on a global basis here, where last time it was at 52.8. The ISM services PMI, this was the big one. It actually came in weaker than expected, and this helped interest rates to go down. It came in at 52.8. So it's above 50, so it's showing expansion, but they expected 53.9, and last time it came in at 54. Here are some charts. Here's the weekly MBA mortgage applications. Did come up just a little bit from the previous reading. And the ADP employment change also going up just a little bit here. And here's the monthly look at the trade balance where we are actually coming down when you take the 3-month average overall. Now, this is probably going to change a lot with the tariffs and all that stuff that's been going on now. And then nominal exports and imports on a year-over-year basis, where we're going up with the imports and down with the exports. It may reverse going forward from here. And then the deficit really showing, and this might have been some, okay, we better get in and do something fast right now, like buying things from other countries before all these tariffs really kick into gear. That's just speculation that that may have happened. And then the non-manufacturing index, we did come down with the prices and we're coming down with the total reading, and that did help the market. And looking at some Isabel Net blog charts, this is just showing the valuation and then the deviation from the growth trend that we have here. And the green line is really high right now. We're at 147.65. So we're getting kind of far away. And so this is just suggesting that we're overvalued and that the trend is getting kind of far away from what it normally has been. And volatility, and yeah, we've been seeing a volatile market as we've not been trending. We have a down day, then we have an up day, then a couple of down days, then we gap lower, then we go higher during the session. And this is what we see most of the time is a 3% dip. Um, and then we get a 5%. This is a mild correction. And then it's that 10% level. That's when we go from the idea of just a pullback to a minor correction into an actual correction. And then over the years, we get down to 15%. And then once we fall 20%, that's where we classify it as a bear market. The global market implied the ERPs here. This is just suggesting that we're coming down right now. You can see we have Asia coming down, the US coming down, and we're just seeing a lessening of the risk in there as because people should be compensated for buying stocks. And we have been seeing that really coming down a lot lately. All right, then the 10-year real yield, that takes inflation into account. It's been around current levels for almost a year and a half, so the markets are more used to this setup. Well, okay. This is just seeing it here that we're going up. We have been since we've been raising interest rates, but they're suggesting that as we were going back up, when we climbed back over 4%, now this is adjusting it here for inflation, but the markets didn't seem to really notice. And then there was a period of time when we were going up with the market and up with interest rates where they tend to go in the opposite direction. And the market kind of got used to that. And then it started to get nervous once we got above that 4.5% level with the 10-year yield. And this shows how the 10-year yield and the dollar index actually track pretty closely with each other. So we've been seeing interest rates going up because it costs more money to borrow those dollars. So then the value of the dollar also goes up as well. And this is looking at gold. It gets the trade war boost here, just the protection against craziness in the world. And then the annualized realized bottom-up consensus of earnings per share growth. This is for the S&P 500, and it just shows that we're still going up here from right the dark blue, that's 2025 and then off into 2026. Then we look at the equal weight version of the S&P, the Nasdaq 100, the mid caps, and there's a big projection for 2025 for earnings to go up with the small caps. Well, they've been having a hard time justifying that as interest rates are going up because it costs more money for these smaller companies. It bites into them a little deeper than it does for the bigger companies. Then tariffs used to make up half of the revenues back in the 1800s here. And that was the main way that the US government brought it in. But then after World War II, everything changed. Now there's stepping back and saying, okay, we're still under a lot of these post World War II agreements here. Do you think maybe we ought to go in and change some of these things? And that disrupts the status quo, and it's change and it's unfamiliar, and people often don't like change all that much, where other people thrive on change. So just kind of working it out as we're seeing this new administration trying to just see what it can get done here. Okay, didn't spend any time on Twitter. Just busy doing other things right now. Now, the positive takeaway from this is if you go back down to the gap that we had on Monday, look at the positive price action that we've seen since that time. Now, it hasn't been straight up, but for over most of the time since we've been trading this week, once we hit this low, we have been seeing a nice little multi-day advance here on an intraday basis. Where in Wednesday's session we did open lower down below the daily pivot, didn't quite get down to S1, got back up to the daily pivot, and then eventually went positive and got up to S1 and closed at the intraday high here. So this looks better on an intraday basis, but when you take the last three trading days together, it's looking even a little more positive. And then we were actually down more in the initial overnight session. This is after Google reported earnings. And then it looked like, oh boy, here we go. We started off down and then we came back up here. And then we eventually went positive and we're up just a little bit in the initial overnight session for Thursday. Still looking good here with the blue line above the red line as growth outperforms value. And this is still looking good too. Going back to the latter part of January when we bottomed out, this was the deep seek day when everything crashed down and growth really took a hit and Nvidia was down 17%. Well, we've been clawing our way back. Now, we didn't have a great day on Wednesday, but we're still seeing an overall trend on the intraday chart. So end of day, growth was up a little bit more than value for the large caps, and the stronger area of the market was the mid caps. It was up over 1% with growth, and it was up a lot more with the small caps. So looking at our end of day charts, we're going back up and still looking strong with the small caps. But if you look at the index, we're just coming back up to levels that we've been at before. So it's not like we're really breaking out to the upside here. Looking good here with the mid cap growth to value ratio as well. But again, we still have a ways to go to get back to previous levels for the mid caps. And the S&P growth to value still looking pretty solid and starting to break out. So this is strength under the surface that's been continuing to build as we've been going through this choppy time. Seeing a bit of an improvement, but we're still in the rainbow when we look at the growth versus value ETF here and do a ratio. Discretionary still looking good when compared to staples. We're still above the 50-day moving average with the large cap growth ETF. And as far as our trend, still going down with the ADX. That means we're not trending. And since we're below the blue line, that's the line between trending and not trending. That's a static line that I use with this indicator. And then I plot a moving average on here to give us the overall context of the direction. And so we're still not really improving as far as the trend condition, but we are improving in that we're going from green back above the red line here. And you can see we've been really choppy lately. So if we have a down day, this might switch back to negative. If we continue to go up, this might build up the green line here a little bit. And even in the short term, we're still looking somewhat positive here, but just not trending right now. And if you remember back over the weekend in the weekly chart, we're not trending there either. Okay, we came down, but we're still above average with volume. Then, as far as sentiment, because of the up day, we're going down with the VIX, both with the line chart and the bar chart. We're also declining with the VIX of the VIX, coming underneath the moving averages here. And we're starting to roll back over as far as the momentum of the VIX. We had been starting to go up as the VIX was going up, but lately we've been coming down. And so now the MACD is starting to roll back over. That's more positive for stocks. Still giving us a pretty extreme reading with the skew index, which is a variation of the VIX. There's still a big move that's expected. And we went down with this fear gauge and went up with this other fear gauge. So seeing a bit of contradiction there. Went up a little bit here on the daily chart with the equity put call ratio, but we're going down with the 5-day chart. And here's a longer term look. When we get under this green line on this chart, which is actually a red line here, and I turned it green on this chart, this is an extreme reading. This might mean that we're getting a little too complacent overall, but we could still drop further than where we're at right now. And then we look at a 10-day moving average here where we're still going up. So again, this is part of the choppy market that we've been seeing lately. And into the band right now, as far as the volatility risk premium, we're coming back up. We ticked down a little bit on Wednesday, still not really showing an increase in fear looking out 30 days. Seeing a bit of an improvement where we were seeing some weakness after Tuesday with the advanced decline line based on price and volume. We're still longer term positive as long as we're above these moving averages and the moving averages are going up. And we switched over to negative with the advancers minus decliners on a 10-day basis. We dropped below zero. Well, we were able to get back above zero now as we saw some of the rest of the stocks in the S&P 500 do better. Still showing some weakness here with the new highs minus new lows. We're going down with the 5-day and the 10-day. But you can see here, we saw an expansion of the new highs and a contraction of the new lows. So if this can continue, that would turn these moving averages back up. And we turned up a little bit with our advanced decline ratio, both in the short and intermediate term. And we're still positive here since both are above zero. This is one of the smart money indicators that might start being to look. Okay, let me try that again. This is one of the smart money indicators that is possibly starting to look a little too extreme. We're getting far away from the moving average here. This measures price and volume together, and it's been really looking pretty solid lately. Now, this indicator down here is supposed to measure how far we are away from this moving average, but you can see it's a modified MACD that I use here. And sometimes it's pretty accurate. Well, it's been off for the last number of days, but we are getting kind of far away from this. And when we get too far away, we have a tendency to come back, which would be more negative. And we're showing a real improvement here with the chicken money flow. We're going up here. Now we're starting to possibly get to an extreme area. Don't have really a defined area. You just kind of have to eyeball it based on what's happened in the past. But we could still go up more from where we're at right now. And this, I do put some lines on here. This is an oscillator. This is our third smart money indicator. We turn back positive. We're above the red line, and we're starting to get up here to the green line. But it doesn't mean we have to stop here. This is just areas that we really pay attention to this. And we actually came down a little bit with the vortex. The green line came down, the red line came up, but we're still positive because the green line is above the red line. And not much of a change here with the cumulative advanced decline line based on price, just been chopping sideways as the trend has been. Saw a little bit of an improvement here based on volume and a little bit of an improvement here with the S&P going up, and we're seeing the NYSE advanced decline line show some improvement. And they're getting closer to each other. Even though they're on different scales, when they really deviate from each other, that's usually telling us that one part of the market is outperforming the other part of the market. And we did see an improvement here with the cumulative advanced decline line for the NYSE. Not really breaking out yet, but still above the moving average with our regular NYSE advanced decline line and then a different regular NYSE advanced decline line here. And a little bit of an improvement with common stock based on price and volume, and an improvement with our advanced decline lines, coming back up with the common stock, turning back up with the S&P mid caps, and the small caps cross back above the moving average. We're still above zero with the 5-period moving average of the highs and lows across the broad market. Turning back up with the stocks inside the S&P above their 20-period moving averages. We were concerned because this kept declining even on up days. Well, the fact that this turned up slightly is a bit of an improvement there. And we dropped below 50 with the 50-period moving average study. Well, we were able to cross back above it. We also came back above 50 with the 100, and we had been declining with the 200, well above 50 though, but we saw some improvement there as well. And we're still above average with volume, still above the 50-day moving average, but you can see we're just kind of chopping around right now. A little bit of an improvement with the 20, 50, and 200 period moving averages on the S&P. And our short-term indicators, they're just kind of floundering around, not giving us an extreme positive or negative reading, which is usually what we see when the market's really moving in one direction or the other. And the Williams percent R is above its midpoint, but not extreme. The CCI 14 at the midpoint, as is the CCI 20, a little bit above the midpoint here, but none of them are extreme right now. The stochastics, none of them are extreme. Turning back up in the short term, still declining in the intermediate term, and trying to turn back up at the longer term. And this is just a further subdivision of the short term time frame. Turning a little bit more positive and coming back up to the midpoint with the force index. Still going sideways here with the condition of the short-term trend. If we can stay above these lines, that would turn them back up. We're above the 20-period simple and exponential moving averages. That's why the short-term trend is positive. We're above the midpoint here with our standard deviations chart. Still looking pretty solid here with the balance of power. We're above zero. The go, no go is still on the neutral side of positive with the lighter blue bars. Above the midpoint here with the highest high value chart. And we're turning back a little more positive with the TTM squeeze. When we saw the darker blue, we were starting to go down. It actually advanced and turned to the lighter blue. So that's switching back and looking a little more positive there. We declined with the ease of movement, but we're still above zero. We're still flat with the Arun indicator. It's just not picking up anything right now. And we just barely went negative with the McClellan oscillator for the S&P. Well, we bounced back up here, so we're looking a little more positive. But when we look at this, we're seeing a negative divergence. We're starting to go back up with the summation index based on price for the S&P. We're still declining based on volume, but it's slowing down a little bit. And we went slightly negative with the McClellan oscillator on the NYSE. Well, we bounced back up there. So after a brief stop, we're not really going up based on volume, but we are starting to advance again based on price. This is showing some improvement too. For over a week now, we've been seeing the Swenlin trading oscillator declining based on price and volume. Now we're seeing them both starting to turn back up. Now they're still below zero, and we're going to need to see some follow through with this, but this is showing an improvement. And we're seeing a weakening of the overall momentum. The PMO is rolling over, but still positive, and we're turning over, but still positive with price, getting close to the moving average here based on volume, and seeing a bit of an improvement with the PMOs that are rising. We're still declining with the buy signals, still going up slightly with the PMOs that are above zero. And we've gone from negative to neutral to positive with the Elder's Impulse system. I mean, that you're not seeing a lot of the same color at the same time here. They're changing colors every day. But we're still negative with the parabolic SCR. We're going to have to climb up further here to turn this back positive. Here's the slope oscillator where we're actually coming back up and just barely above the moving average here, but we're extreme positive when we get above this green line. That's why I have it on the list. And the MACD was almost getting ready to roll over negative, just barely starting to turn back up. So we're seeing a bit of an improvement here with our short-term oscillators. Still kind of indecisive here with the intermediate term indicators, but we're still positive with our long-term oscillators. The copy curve is weakening, but still positive. Sean trend meter is still looking positive. The money flows above 50, that's positive, as is the ultimate oscillator. So those are secondary indicators that are positive. Still above the moving average with unbalanced volume. Still above 50 with the RSI 14 and 9, short and intermediate term. So that's positive. The condition of the intermediate term trend, we're also going sideways with the blue line and the red line right now. And we're above the simple and exponential moving averages here in the intermediate term. That's why we're positive in that time frame as well. So we're still above all the plotted moving averages here, even though we've got this spaghetti mess going with these moving averages. This is the mass index, and I may drop this here pretty quick because this was triggered back in January and it's trying to anticipate a reversal. Well, we just keep chopping around right now. We're still working off of a buy signal with the Pring bottom fisher, though. That was generated back in earlier part of January and actually would have been a pretty good signal. But since that time, we've just been floundering and seeing an improvement, but still leaning negative with the bullish percent index here for the S&P. We are improving here with the NASDAQ 100 bullish percent index and ticking up and just barely getting back above 50 with the NYSE bullish percent index. And we're still above this mini rainbow here with the 20 period simple moving average of the open, high, low, close, and the lines are still going up. So that is still looking more positive. But longer term, and I've been pointing this out for it seems like forever now, we're still hitting the upper end of this trend channel going back to 2009. And we're going to have to really need some strength to break out above that. The market doesn't seem to have that right now, but that could change at any time. So we're looking a little more positive with the Heiken Ashi chart. We're negative but pointing up with the Kegi chart. We're positive with the Renko chart, and we're positive with the three-line break chart. So longer term, seeing a bit of an improvement, but not much of a change with our 150 and 200-day moving average studies. We're positive across the board on all time frames. Now, with all the different stock indexes that we look at, we've switched back to positive in the short term with bonds based on price, positive across the board with commodities, and now the dollar is switching back to a downtrend in the short term. So we saw materials, communication, and discretionary. These bottom two are growth areas, and they actually underperformed, and that's really what kept the overall S&P in check and the Nasdaq 100 as well. Those areas underperformed, where some of the other areas actually had a better day. And seeing some red and green here, if you're into the show, eh? The red green show. It started off with a bearish MACD crossover. Now, we're not seeing that. It may have started right after the open, but by the time we closed, that crossover ended up not happening. We had a BPI cross above 50 with the NASDAQ. Now, I tracked the BPI for the NASDAQ 100. So this is showing that the NASDAQ itself is looking a little bit more positive. But then we had the NASDAQ crossing below 19.6. It really didn't participate as much in Wednesday's advance. Staples had a BPI cross above 30. We're going to be keeping an eye on that. That's more defensive. And if that really starts to do better, it might mean the market is getting set up to decline. But we're not going to go with everything just based on this because it's really been getting hammered lately in that area. Where discretionary is actually seeing a little bit of weakness here. And then real estate had a BPI cross above 50. And probably what helped that were declining interest rates. Because when interest rates go up, that really affects the real estate sector. So, still a bit of a disconnect between the weighted and equal weighted version of the S&P here, but a bit of an improvement with both. The Dow not back in an all-time high yet, but it was up 0.71%. And the diamonds are still neutral though. The Nasdaq up 0.19%, still above its 50-day moving average and still above this pivot point for the month of February. And same thing with the Nasdaq 100. We're above the pivot point, up a little stronger, up 0.42% above its 50-day moving average. And the Qs are still positive with the green bars with the Elder's Impulse system. The momentum is trying to turn back a little positive here, but we're just kind of flatlining overall. And this is the first index of the small caps, the S&P 600. We're not up to the 50-day moving average here, but we did get above the 50-day moving average with the other small cap index, the Russell 2000. So, but we're not really breaking out yet. We're just getting to the higher end of this recent range that we've been in. And we're positive, again, going from negative to neutral to positive with the Elder's Impulse system for the small caps, getting above the 50-day moving average with the mid caps, and going from negative to positive here with the Elder's Impulse system for the mid caps. Looking even better, this is a broad market measure, the Wilshire 5000. We were right at the 50-day moving average, then we closed above it. Now we've advanced a little bit more above it, and also improving above the 50-day moving average with the total US stock ETF. The financial sector was up over 1%, so that's looking pretty good there. The FANG index was up 0.46%, still in a solid uptrend. These are the big mega cap stocks. Apple was down 0.14%, where you had Meta, just barely, but setting a new all-time closing high there. Amazon was down 2.43%, but still looking pretty solid. Microsoft underneath its 200-day moving average, up 0.22%. And Nvidia, after really getting hit down below its 200-day moving average, it was up over 5%, getting back up to its 50-day moving average. And Google, they were down over 7% here. It came in with a good earnings report, but it's like you're spending too much money to do new things. So they're coming back down here to their 50-day moving average. And Tesla was down 3.58%, still under its 50-day moving average there. Netflix up and setting a new all-time high. And seeing a real drop off here with the US to world stock correlation in the short term, flatlining here with the long-term correlation. Oil still dropping down. We're at the lower end of the 70s right now. And the dollar's pulling back, but coming down and dealing with its 50-day moving average again, but it's still in an uptrend. And then dropping down below the 50-day moving average and also dropping down below 4.5% with the 10-year yield. And so here's the intraday chart where we've been just watching this here, and this 4.5% level had been providing a level of support, and we just kept bouncing up from it. Well, we dropped down below that, and that could help the rest of the market if interest rates continue to fall. So we're going up above the 200-day and 50-day moving averages here with the 7 to 10-year bond based on price. We're keeping an eye on this chart. These are the rates in Japan. This is a weekly chart, so it's going to look different by the time we finish out the week. But this is what caused some problems last summer with where interest rates going up in Japan, and then that came through the whole world there. If rates continue to go up, that may be a problem. Looking at our growth to value ratios, a little bit of an improvement here with the Qs to S&P, actually declining under the moving average with discretionary to the S&P, and still below a declining moving average when you look at large cap growth versus value. So the large caps not really looking all that strong now. The mid caps are really improving, and the small caps are above their moving average. So what's our outlook for Thursday? We're still positive. In these improvements now, we're leaning a little bit more towards the positive side, where after Tuesday, we were leaning more towards the negative side, but we're not trending. So we have an up day, things are going to look better. We have a down day, things are going to look worse because there's really no conviction to overall price movement right now. We're going to get initial jobless claims, productivity, and unit labor costs, and pending home sales in Thursday's session. And then what else is new? What new executive orders are going to come out? What country is Trump saying we're going to buy this time? I mean, it's been crazy. And the news has had a really difficult time. They start complaining about what he did yesterday, and then it's moved on to the next thing, and they don't have time to freak out about it. Okay, so then we're looking at the employment situation report coming out on Friday. Here's a look at the Thursday area that's blocked out here with the Friday, at least the previous results that we saw there. Seasonality, we are positive for February 6th, both with the Dow, S&P, and NASDAQ. And coming up, getting a little closer. Well, I mean, we still have 10 days to go or so, but first half of February tends to perform well, or the second half tends to underperform. And this is looking at this window of time here during a post-election year where February is not a real friendly month. And then here's the first half of February following the second half of February, according to the Carson chart. And then during a post-election year, this is not a good performing time. And small caps, me, are they going to finally be able to kick into gear and really do something? They've got some making up to do. They haven't really broken out, but they did improve in Wednesday's session. So we still have the parabolic SAR that is negative, and we have the 5 day actually going up here with the equity put call, and we have the mass index, which again, I'm probably going to take that off pretty soon because it's becoming more and more irrelevant or less relevant, I guess would be a better way to say that. We are, whoops, I got the box a little bit weird there. The accumulation distribution, Chaikin money flow, and Chaikin oscillator. They are positive, but possibly starting to look extreme. The growth to value ratios, discretionary to staples, they're still looking fairly well, holding up. We're still going down with the 10-day chart of the equity put call ratio, and we're improving with the advanced decline lines after we had been showing some weakness. The ease of movement is positive, and we're looking a little bit better here with the McClellan oscillators for the S&P and NYSE, but we're still declining with volume for the the S&P 500. And we're showing some weakness right now with momentum because we're not trending. We're just floundering around. And so our oscillators can't help but start to weaken here. And we are seeing an improvement with the Swenlin trading oscillators actually turning back up now. Can that continue? And we're seeing an improvement with the bullish percent indexes. And the vortex is showing it came down, but it's still positive after it had been improving. The money flow is positive, the ultimate oscillator is positive, and we are seeing an improvement with our moving average studies here. And the financial sector is positive, and we're now looking flatlining to slightly positive with the NASDAQ 100 momentum. So, our conclusion, we are still positive. The improvement is happening here, but we're not trending. And that's what we're seeing both in the short and intermediate term right now. But we're still continuing to be positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.